Okay, gang, we are now on the board and we are ready to rock and roll with some fundamental transaction analysis. But first things first, it's a methodological approach of how we come to the right solutions in terms of recording and reporting. And basically with accounting, you're gonna get a lot of word problems. And so what we like to do first is identify the keywords. The keywords game will always, most of the time, get you to the right accounts that are affected within the following transactions. And so without any further ado, let's look at the very first transaction that we have for this particular company. So January 1st, it says It's a Joke received $20,000 cash from investors in exchange for common stock. And so what we want to do, gang, is we want to first identify the keywords. Always identify the keywords in the transaction. Received cash, definitely big keywords, and common stock. Those are the keywords. So now that we've identified the keywords, it's pretty much easy for us to identify what accounts are affected. So the first set of keywords, received $20,000 cash. Can anyone guess what account is affected when we receive cash? Obviously so, cash, okay? Now, we receive cash, but what did we do in return for receiving cash? We being It's a Joke. We issued some common stock. So those are the two accounts, gang, in this particular transaction that has affected the accounting equation. So with that being said, let's look at our accounting equation. Our accounting equation is assets equals liabilities plus stockholders' equity. Okay? And so we've already identified the two accounts that are affected, cash and common stock. So our next point of entry is to identify what families those accounts belong to. So we have cash here, right? Cash happens to be an asset, and so our assets have been affected. How has our assets been affected? Well, we received cash, gang. So obviously our assets went up, okay? So our assets went up. I'm gonna put a plus $20,000. And what account particularly in the asset account caused the assets to go up? Our cash account. So clearly, looking at this particular accounting equation, we are not finished because we know that our assets equals liabilities plus stockholders' equity. So the other account that was affected in this transaction happens to be common stock. Now, common stock is a part of stockholders' equity. So we issued common stock for cash, which basically means we have more cash outstanding for our investors. More investors own our shares of stock. So with that being said, our common stock has now increased, causing our stockholders' equity to go up as well. So our stockholders' equity increased from this transaction by $20,000. And the account that caused stockholders' equity to increase obviously was common stock. And so this is our first example, gang, of transaction analysis. And we're gonna do a couple of more to get the gears running. But the thing that I really want you to identify is the keywords in every description, because the keywords will properly guide you to the right solutions. Transaction number 2. It's a Joke received $4,000 cash from customers for services performed. As always, first things first, gang, we are going to identify the keywords. What are the keywords? Received cash and services performed, right? So once we identify those keywords, then it's time for us to find out what accounts are affected. The keywords are going to always guide us, so we know already that we receive cash. Cash is an account that's affected, and services performed is the definition of what we know to be called revenues. Anytime that we provide a service or sell a product, revenues are being generated. So now that we have the accounts both cash and revenues affected, our next step will be to know what family they belong in and how are they affected. So cash, as we already know, is an asset, and since we received it, our assets has increased. What about revenues? Revenues is an account that happens to affect stockholders' equity, and it does so by increasing retained earnings. Remember, gang, retained earnings is income, and income is defined as revenues minus expenses. So anytime we have some revenues that we are earning, our stockholders' equity collectively is increasing. So if we were to apply this with our accounting equation, we would see that our assets have went up by $4,000 under what account? Cash. In this transaction, we had no liabilities. Remember, liabilities are things that we owe. And stockholders' equity, as we already know, stockholders' equity is broken down into two parts: paid in capital and retained earnings. We already identified that revenues affects retained earnings positively. So our stockholders' equity went up $4,000, and it was through the revenue account. And so we see how this particular transaction has affected the accounting equation. And now our assets still equal our liabilities plus stockholders' equity at all times. Transaction number 3. January 5th, paid $200 cash for office supplies. So before we get into any keywords, there's a significant keyword I want you to start memorizing. And that keyword is paid. Now, since you guys been born, you understand the concept of paid. When you pay for something, there's only one way, and that one way is to use cash. Anytime you paid for anything, you used cash. So anytime you see the word paid in the illustration and the company is paid, then guess what? Cash has been affected. Not only has cash been affected, but it's been affected by going down. So in any illustration or transaction, when the company has paid for something, cash always goes down. Remember that. So what are the keywords we have? Obviously cash and office supplies. So this one is pretty easy, gang, right? So what accounts are affected? Cash and office supplies. And we already know partially how the accounts are affected. Because of the keyword paid, which tells us cash goes down, our cash has went down. And why did our cash go down, gang? Because we purchased office supplies. So office supplies obviously has gone up in the company, okay? So we've identified the accounts, and we also identified how they're affected. The last thing we must do for this transaction analysis is identify what categories, what families they belong in. As we already know, gang, cash is an asset, but guess what else? Office supplies is also an asset. So how would that affect the accounting equation? Well, we have assets equals liabilities plus stockholders' equity. And we know no liabilities were involved. Liabilities are things that we owe. And we also know stockholders' equity wasn't affected as well, because stockholders' equity is broken down into the two parts: paid in capital, which is common stock, and retained earnings. So that leaves us with our assets. So how was the assets affected? Well, one of the assets went up by $200, simultaneously causing another asset to go down by $200. So our assets increased by $200 under what account? The supplies account. But at the same time, gang, our assets also went down $200 under what account? The cash account. So, quick question. What was the effect on the accounting equation? What was the effect on assets? No change. Our total assets did not have an effect. Why? Take this for example quickly. What if I gained 5 pounds in my head, but lost 5 pounds in my feet? I still weigh the same, right? All I basically did was shift the weight from one portion of my body to another, but the total weight of me hasn't changed. Same thing applies here. Our total assets has not changed. We just shifted one asset into another. So 0 equals 0 plus 0. We are definitely done. Transaction number 4. January 9th. Perform services for a customer and bill the customer for services rendered $5,000. All right, gang, let's rock and roll. We know what we're doing. Keywords. So, what are the keywords? Perform services and build customer. Let's take that one. Build customer. Perform services and build customer. As of now, you should be getting familiar with the word performing services. If a company performs a service or sell a product, that generates revenue. That's how companies earn revenue. Therefore, revenues are affected. Now, we provided a service for the company, for a customer, and we billed them. So did we receive cash? Nope. So what did we do? We set up an account to receive cash in the future. And we know that's a definition for an accounts receivable. So our service revenues were involved and our accounts receivable were involved as well. But how were they affected? Well, clearly we know anytime you provide a service or sell a product, revenues are going up in the company, right? What about our accounts receivable? Well, we billed the customer, right? So we're expecting to collect in the future. So our accounts receivable has went up as well. So now that we know what accounts are affected and how they're affected, how did it affect the accounting equation? So our good old-fashioned accounting equation, assets equals liabilities plus stockholders' equity, right? Were assets involved? Yes. Our assets went up $5,000 under what account? Accounts receivable. Now that's a long word, gang. I'm gonna just put AR, but y'all know what I'm talking about. Accounts receivable. Were any liabilities affected? Liabilities are things that we owe. Absolutely not. Okay. What about stockholders' equity? Yes, stockholders' equity was affected, and it was affected through the revenue account, which affects retained earnings. Retained earnings is a stockholders' equity account, but it is affected by other outside accounts, and revenue happens to be one of them. So we generated some revenue, therefore our stockholders' equity went up by $5,000 under the revenue account. And we are done. Transaction number 5. January 10th. Received a $300 utilities invoice due in 2 weeks. They're getting kind of clever and sneaky, aren't they? So, remain calm, identify the keywords. So, let's see, what keywords do we have? Utilities invoice? Utilities invoice due in 2 weeks. Okay, all right. So we have a utilities invoice due in 2 weeks. All right, gang? So one of the most significant keywords in here, I would say, would be utilities. Why? Because basically, gang, we received a utilities bill. But as a company, we know that utilities happens to be an expense for the company, right? So anytime you receive a utilities bill, just like advertising, right? It's an expense. So utility expense has been affected in here, all right? Now, utilities is an expense account, but that particular account affects retained earnings. Remember we said retained earnings is income, and income is revenues minus expenses, right? So let's elaborate on that. Let's investigate that. We received a utilities bill, so our utilities expenses has gone up. But how does that affect stockholders' equity? Well, the fact that utilities expenses has gone up, it will cause our retained earnings or income to go what? Down. Therefore, stockholders' equity has gone down because of the increase of this expense causing it by $300. Okay? So, we always know that there's another account that's being affected in this, right? So we know utilities expenses are affected. But what other account is affected in here? Let's look at the keywords, gang. Due in 2 weeks, right? So we received a bill that's due in 2 weeks, which means we still what? Owe. We owe. So guess what? Anytime we owe, that means we have a what? Liability. We have a liability on this utilities bill, or should I say, this utilities expense. So since we haven't paid on this utilities expense yet, a liability must be created. And so we know most of those last names of those liabilities are going to be payables. We're going to affect utilities payable. Okay? So, were assets involved in this transaction? Absolutely not. That's a first, all right? So no assets were involved. What about liabilities? Yes, because we owe on this utilities expense, right? So since we owe on this utilities expense, our liabilities has increased by $300 under what account? Utilities payable. Last name payable, it's a liability. Now, what about our stockholders' equity? We already said that the expenses went up, causing our stockholders' equity, particularly retained earnings, to go down. Remember, stockholders' equity is broken into 2 parts, gang, paid in capital and retained earnings. And so since retained earnings is income, when expenses happen, the income goes down. So our stockholders' equity is going down by $300. Okay, I'm gonna put this in parentheses. It's going down by $300 under what account? Utilities expense. And this is a fairly complicated concept for many to understand the first time, so I strongly suggest rewatching this portion. Transaction number 6. January 15th, paid for advertising in a local paper of $250. What are the key words, gang? Paid and advertising. So we already know when we see the word paid and the company is paid, cash is going down. So we already know how our cash account is being affected based on that one key word. So what about advertising? What do we pay on? Advertising. And what is advertising to the company, gang? It's an expense. So anytime we pay on advertising, it's an expense to the company. And we know how expenses affect stockholders' equity, right? Stockholders' equity is broken down into 2 parts. Paid in capital and retained earnings. Retained earnings happens to be the income the company keeps. And we measure income by taking our revenues minus our expenses. So anytime we have expenses in the company, gang, it decreases our income, thus decreasing retained earnings, which happens to be a part of stockholders' equity. So how does this affect the accounting equation? We see the keyword paid, so we know that our assets went down by $250 under what account? Cash, of course. We should know that we have no liabilities, no things that we owe. And we also know that our stockholders' equity is going down because of our advertising expenses. And we are done. Transaction number 7, January 25th. Collected cash in full from customer billed on January 9th, $5,000. All right, so basically what happened, gang, is we had a previous transaction on the night where we provided a service and we set up an accounts receivable for $5,000. Now it's the 25th of January and we're collecting from that customer. So what are the key words for this transaction? Collected cash from customer billed, right? So what accounts are affected? Well, obviously we collected cash, so cash is going up in the company and cash is an asset, so our assets are increasing by $5,000. But what about the account receivable that we had, gang? That previous accounts receivable, we've collected on this account. What should happen to that accounts receivable? Think about it. Previously, we had set up an account to receive in the future. Now the future has become the present and we receive the cash. So when you collect on an account, that account receivable must go down. And since accounts receivable is an asset, our assets will be going down as well. So how does that affect the accounting equation? Our cash is going to go up by $5,000 under what account? Cash, obviously. And our assets are going to go down by $5,000 simultaneously because our accounts receivable must be decreased now that we collected on it. In this transaction, we didn't have no liabilities, nothing we owed, and we didn't have anything that affected stockholders' equity, particularly common stock and retained earnings. So we are done with this transaction, gang. Last but not least, the final transaction. January 31st, paid cash dividends of $4,000. All right, gang, at this time of the road, hopefully you guys are understanding the key words and how useful and beneficial they are for you coming to the right answers. So again, paid, dividends are the key words. And anytime we see the word paid, gang, we know that cash is going down. Cash is an asset, so keep that in mind. What about dividends? Well, we paid the dividends, right? And dividends happen to affect stockholders' equity. Remember, gang, stockholders' equity is broken down into two parts. The first part is paid in capital, which is common stock. And the second part is retained earnings. Retained earnings is also known as income. We define income as revenues minus expenses. However, dividends is a distribution of income to the shareholders. So anytime a company decides to give income to the shareholders in the form of dividends, it decreases retained earnings. And since retained earnings is a part of stockholders' equity must go down as well. So, based on this transaction, our assets has decreased by $4,000 because of the keyword paid. Under which account? Cash. Did we have any liabilities, anything that we owe? No. But we know now that dividends affects retained earnings, which decreases it. So therefore, our stockholders' equity must go down by $4,000 through the dividends account. And so our transaction analysis is complete, and our assets after every transaction has equaled the liabilities plus the stockholders' equity. So that pretty much summarized how to properly perform a transaction analysis. And I would strongly suggest that you apply the methods that we've been doing for this video, gang. Always let the key words identify the tips on which accounts are affected and how they affect it, so that you can be able to properly see how the accounting equation has changed. So with that being said, I hope you're learning, and I hope that light bulb is firing up there. And if it is, don't forget to like, subscribe, or share the channel with your friends so that you all in a group can chase the bags with this accounting information. See you soon.